What's up, everyone, and welcome to the Daily Macro Update for Monday, August 11th. Taking a look at some of the headlines here. A little bit of a quiet day, not too much in macro. The market is anticipating the inflation report tomorrow that comes out at 8:30 in the morning. And yeah, some tariff news coming out. And so the market is being a little bit cautious here. Taking a look at the S&P 500, it did have a little bit of a down day. It came right up to the top end of the trading range and then rejected from there. And so, yeah, interesting, seeing how the market is reacting here on lower volume. So the market has about, 15 more minutes or so before it closes. But look at that volume drop off, right, as it, continues to the top end of the trading range. That's a clear bearish divergence. I was buying some gold today. Gold was having a little bit of a correction. Bitcoin had a bit of a whipsaw here near the top end of the trading range as well. So that was pretty interesting. But yeah, we have inflation obviously tomorrow. And we'll get into that in a little bit here because it ties into the topic of this video today, which is how the government, with its debt, is propping up the market, causing a lot of this hype that's going on right now, despite the low sentiment, within traders and investors on the retail side. Now, the way that this is happening, and we're getting everything announced as well, right? Is obviously the United States has a big debt problem, and part of the reason why the deficits are growing is because on top of all of the increase in spending, there's a large portion of it that's going towards interest payments because of the high levels of interest rates that are currently, imposed right now. And that is mainly guided by the Fed funds rate, which is the rate that the Federal Reserve sets. Now, part of the reason why things are coming to a crunch period as of right now is because the main areas of funding, the government deficits over the past couple of years, which were one, the reverse repo facility, that is at, pretty much drained levels, right? There's 82 billion left that's in here. Back in 2023 at the beginning of it, or at mid of it, there was around $2 trillion. So, the major part of the RRP is drained. And then when it comes to the Treasury general account, the Treasury actually put out an announcement, which we'll go over here in a second, that they actually need to refill this to 800 billion by September. So in a matter of weeks, this needs to double, which when liquidity is building up the Treasury general account, that is actually liquidity being taken out of the financial markets, right? And so there's no surprise that they have about $80 billion left to drain out of the RRP if they want it to go to zero, which I don't think they can get it that low. But even then, you still have to get a lot of cash from somewhere else. And that's part of the reason why we're seeing the government shore up a lot of cash with short-term debt, which we'll get into here shortly. But the main thing, the overarching theme here is that the government is cash insufficient, right? They're running out of options. And so the main point that I want to make right now is that, when we take a look at Treasury issuance, right? So remember, Treasury bonds, bills, notes, this is all debt that funds the government deficits, right? Whatever the government doesn't collect in taxes, whatever the difference is between how much they have to spend by law versus how much they take in, they have to borrow that remainder, which makes up the deficit, right? And so if they don't take in that much revenue, but the amount that they have to pay keeps going up, well, then the deficits get larger and larger, and that's what's happening right now. And so the thing is that they can't issue treasury bills, which are a little bit more stable, because of how high interest rates are. The Treasury Secretary, Scott Bessent, has gone on CNBC and a lot of these major financial and entertainment networks to say that, why would we issue bonds and lock in these high rates? So we're going to continue issuing bills. And so what this is doing is this is injecting cash into the markets, but at the same time, it's increasing what's called rollover risk. So all this debt, matures anywhere between a year or less than that, right? So all the debt accumulation over the past couple of years has to continuously be rolled over. And the more and more they borrow at these higher rates, that causes what's called rollover risk, because at some point, people are going to see the ballooning deficits and say, hey, if you want me to buy your debt, you're going to have to offer some higher yields. And so you'll start to see treasury yields go up, which that's not what you want to see if you're someone who owns bonds, right? And so just going back to some of the different announcements here, if you guys don't remember, on July 8th, the Treasury put out its guidance on additional borrowing and bill issuance for the remainder of the year. And I'll just go over this real quick here. It says, with the debt limit now increased by $5 trillion, the Treasury plans to increase issuance of Treasury bills to continue financing the government and to gradually rebuild cash balance over time to a level more consistent with the Treasury's cash balance policy, which is around $800 billion. Initial increases in bill issuance will be focused on shorter tenor benchmark securities, specifically 4, 6, and 8-week bills. And the Treasury does not anticipate issuing cash management bills to rebuild its cash balance, preferably to rely on an increase in its benchmark bill issuance, which is not true, because when I took a look at this, when we take a look at cash management bills, CMBs, which are essentially Treasury bills, but they can define custom maturities. This is essentially emergency cash that they need. Whenever this goes up, that's their demand for emergency cash. That has had a huge acceleration in July, right? So that part of that's a huge lie. And then continuing on here, based on the current fiscal forecast and this issuance plan, the Treasury expects that its cash balance will reach approximately $500 billion at the end of July, which it did not do, right? So this was on July 8th. If we take a look at the cash balance itself, it's at $460 billion. So that they did not reach their goal here. So the Treasury will carefully monitor, blah, blah, blah. And then on July 28th, we saw, since they, weren't able to meet their mark, they came out with this announcement for marketable borrowing estimates, essentially saying that between September and October into the December 2025 quarters, the Treasury expects to borrow $1.007 trillion in privately held net marketable debt, assuming at the end of September, cash balance hits $850 billion, which from right now, 850 from where it's at right now, that's, approximately another $400 billion that's going to be drained out of the financial markets. And so this is net marketable debt, so that's on top of what they're already spending. Now, the Treasury expects to borrow $590 billion, assuming end of December cash balance of $850. And so they're essentially saying that they're going to need to borrow a lot more money, and so they're going to have to keep issuing this these treasury bills. And so that's why we saw this huge jump in Treasury bill issuance for the month of July to levels that we really haven't seen since October of 2024. That was the latest high. And so in short, what this does is it provides a temporary Band-Aid. It suppresses long-term yields because they're using some of that cash in order to buy back some of the debt that's actually maturing, or some of its more or older debt, right? That's what they announced in this quarterly refinancing statement. They said that they're going to do these, they're going to ramp up the current buyback plan in order to buy back their own debt, which is essentially, lowering long-term yields and effectively doing, yield curve control, similar to what Japan does. So this is continuously becoming a more financially or fiscally dominated type of market, which is, in the short term can cause risk on prices, risk on assets to increase in price, which is what we're pretty much seeing, over the past few months. But this does not end well, ladies and gentlemen. And you can take a look at this buyback schedule that they're going to do all the way until November 10th of 2025. Right, so you can see the schedule here: 750 million, 4 billion, 2 billion, 4 billion, 2 billion, going all the way up until November. So they're essentially showing you their exact schedule for suppressing yields on that long-earned curve because the Fed is, not going to drop rates as much as the government would like, and because the government is strapped for cash. Why do you think? They're rushing to put out different legislation that takes money from a certain sector and pumps it into the traditional finance sector. This is the government saying that they need cash. And so for all the crypto people, and I can say that because, I've been in crypto for a while, 2017. For people who are excited about these 401k plans, yes, that'll increase flows into these crypto ETFs, but this is all a plan to try and get cash into the traditional financial markets, because again, the government is strapped for cash right now. They keep increasing their credit card limit instead of and running it up instead of actually doing something about their spending because they can't. And so going back to this tweet that I had, this is great for risk on assets right now, but this also increases that rollover risk that we were talking about earlier. And so for people who are saying like this person right here, who's actually in our group, they said that, they need to lower rates, right? The government has a lot of debt happening right now, and, they need to lower it so that the government can refinance their debt. The only problem is that once that happens, it could be, pretty bad. The main reason being is because not only does that set the precedent for the government to basically get the okay to just go crazy with spending, right? Because you're essentially giving a sugar addicted crying baby its lollipop because you just want it to shut up, right? So you're giving in. And although we know that the Fed works with the government, it publicly likes to show the market the image that it is independent of the government's policies, right? And so if the Fed gives in to reducing rates because the government says so, that is entering a full-blown fiscal dominance era, which that does not end well. If you go back in history and look at different governments and central banks where there was fiscal dominance going on, that's how you get hyperinflation and some other really bad problems. And so there is a slight benefit to having an independent Fed, but its credibility will go down. It runs the risk of inflation reigniting because, look at prices still. They're still high. Have you been to the grocery store lately? If they cut rates right now, that'll stimulate the economy and make prices go up even faster. So if you get inflation, the inflation genie coming back out of the bottle, you're just going to have things get a lot worse than they already are. And so you run the risk of inflation, treasury bills, you're probably going to get even further, less demand from foreign buyers because it sees that, the Fed is a fraud, even though we all know it is already. But they can't just give in to the government's needs. And I wouldn't be surprised for tomorrow if the inflation print actually comes in a little bit cooler than is expected, which, will definitely get Trump, going on Truth Social and saying, "See, Fed, see Jerome Powell, inflation's coming down. You got to cut rates." By just looking at the break-even inflation rate, during July, this came down. But look, I mean, it's still at a higher level than where the expectations were back in June, right? So it's still like if you were just to look at this as like a stock chart, this would be, from April in a bullish trend, series of higher highs and higher lows, right? So that's why when you take a look at the Cleveland Fed's inflation nowcast, let's go ahead and refresh this to today. They have core CPI rising to 3%. Right now, I think it's at like 2.9%, right? Yeah, it's at 2.9. So they have that rising to 3. They think that they have it that inflation is going to remain steady at 2.7%, which is lower than what is being anticipated right now by the market. The market anticipates 2.8%. We'll still see what happens. But then they have it reaccelerating in August to 2.9%. And even if tomorrow the inflation number comes in better than expected, the Fed will come out saying, "Hey, that's great that inflation came down. We're still not going to cut rates because we need to see multiple months of it trending downwards towards our 2% goal. We can't just have one-off month after this clear reacceleration in headline inflation," right? So here it is, right? We reached to a low in April of 2025 of 2.3%. And since then, it's had two reaccelerations in inflation, right? Now, if the Fed didn't cut rates after inflation went from 3% in January down to 2.3%, only 0.3% away from their 2% goal. If it had 3 decelerations of inflation, what makes you think the Fed is going to cut rates when it's been reaccelerating? Because again, yes, inflation needs to come down, but also too, they're worried about the labor market as well. And right now, the unemployment rate is technically at a solid spot, so they're even not going to cut rates there as well. So what I'm saying is that people are overlooking this inflation issue, and as soon as the Fed cuts rates for the political reason of Trump wanting rates to get cut, you're actually going to have more problems. And so the government's strategy right now is to shore up as much cash as possible by issuing short duration debt and try and just stretch and buy as much time as possible. And again, in this effort, you're essentially propping up risk on assets because it thinks that things are just going to get out of control. I mean, that's why the best performing assets so far in 2025 are what? Gold and Bitcoin. Two things that are potentially, well, gold for sure. Bitcoin is still relatively new, but it was originally told as like a dollar, getting rid of the dollar and going to Bitcoin, right? A digital gold, so to speak. But I mean, just look at the price of gold. This is a huge signal, ladies and gentlemen. Since 2023, I mean, really, gold has gone vertical. This is a huge signal. And it's not a good signal in terms of what it's trying to price in for the economy and our fiscal situation. Now, hopefully you own gold and you've been able to take advantage of this run up. I still think it's going to continue higher. It surely looks like that. But yeah, I mean, this is not a good long-term signal, right? Again, short-term, we could continue higher. As you see in the background there on my bookshelf, the bookshelf is still green, meaning that the S&P 500 remains in bullish trend. But at some point, it's not going to be that way. And, it's not a matter of if, it's a matter of when. all these things, shift, because something has to give. Either the Fed cuts rates because we're going into a severe slowdown in the economy, or they cut rates because productivity suddenly has a huge boom somehow, right? A lot of people are saying AI, but again, it's like this AI boom is still in the phase of capital investment, and it takes a long time for that capital investment to turn into cash flow, right? You just think about anything, like if you're buying a rental property, it takes upfront capital to buy that rental property, and then maybe you have a 5 or 8 year ROI until it starts to be a net cash producer, right before you actually like break even on your investment or whatever, depending on how it's set up. So yeah, I mean it's I think the market is hyper focused on just there being zero room for error, and if something does end up breaking, you could just have a big reversal of what's been really keeping up this market, which is essentially the top 10 stocks in the S&P 500, right? You're having a super high concentration. When you take a look at the stocks, the percentage of stocks in the S&P above their 200-day moving average, there's only 56% of the entire index is above their 200-day moving average. And so with the market making all-time highs right here, it's a lot lower than where it was back in 2024, and certainly a lot lower than, in 2021. In 2021, during those market highs, 92% of the market was above their 200-day moving average, and now it's half of that essentially, or not close, not as much as half, but basically there. And then when you take a look at the S&P 500 equal weight, it did put in a new all-time high on July 25th, but ever since July 25th, so far in August, it's done nothing but gone down. And so really equal weight S&P, it's essentially where it's been. It hasn't moved since November. So really for the year, the market is essentially flat. If you, instead of denominating this in dollars, if you denominate it in gold, it's at its worst level since the COVID crash. So instead of denominating the market, the equal weighted market, in a fiat currency as the dollar, if you denominate it in a hard currency that keeps up with inflation like gold, you can almost say that, the S&P 500 equal weight, the real returns have been just in a bear market since it peaked in December of 2021. See that in real terms? It just shows you how much the dollar has just been completely wiped out from the amount of spending that the government has been doing. And so all that to say, I know it sounds like I've been bearish, which I think I am bearish, sort of speak, on the real economy, just because at some point, these chickens are going to come home to roost. But when it comes to the markets themselves, I still remain bullish in the short term until the trend changes. And so, the model that we have, that my team and I use, that we provide for our members, does a pretty good job with, making sure that you're out of the way. Right. The last time I went bearish on the S&P 500 was on February 25th. And so, our model got us out of really this huge 18% drawdown. And then it went back to bullish in about mid-May, on May 11th. And so ever since then, it's been able to get us back into it during this 10% move. Um, Not trying to call tops and bottoms. I'm just trying to have exposure when the market calls to have exposure to it. And so, and then also not have exposure when it's in a bearish trend. And so as this remains bullish, you know, I'll keep following the signal, but at some point it's going to say get rid of it just like it did in February. And so you want to be paying attention to that. And so if you guys want to know exactly when that happens, we have a free newsletter called the Daily Index Ranges. Just use the link below. It's completely free. Every single morning we send you the trading ranges for the SPY, QQQs, and IWM directly to your inbox. There's no fluff. There's no a bunch of scrolling. It's just here's the ranges. That's it. If you guys are interested in that, just go to the link below and put in your information, and we'll get you signed up there. But yeah. So that's the issue that's going on here. I'm really curious on when the market will start to price in that that the Fed cuts might not be as much as expected. Right now, the futures market is showing that the target rate probabilities for the September FOMC, there's an 86% chance of a cut and a 13% chance of a pause. This has grown from just 1 week ago. This was at 9.6%. So I think the market is starting to get tiny little bit of hint that it might not be a guarantee that they cut by 25 basis points, but they're certainly not pricing in that they're going to cut by 50 basis points. Even if they do cut by 25 basis points, you're still at 4 and 4.25 on the Fed funds rate. That's still, way higher than what it was over the past 15 years. So, yeah, I think that a lot of people are just not thinking about the inflation threat. That's still pretty clear. And guess what? Comparisons from now until the end of the year actually get easier. So the year-over-year change actually gets easier for inflation to reaccelerate than it did this time last year. Right? That's why you also have to pay attention to comparisons, right? Base effects. What are base effects? Think of it this way. Say you're just getting into golf, right? It's your first time ever playing golf. You go out and you shoot like a 120, 130. That's pretty bad, right? That's actually quite terrible. But guess what? You just set the bar pretty low. Maybe you take some lessons. You do some... You practice for a month before you go out again. Well, then you improve your score to, let's say, 105. Well, that's great. I mean, a really good improvement. 105 isn't great still, but the base effects were already pretty easy because you scored such a high score that first time you've ever picked up the golf clubs and went out there. The second time you played, it was, pretty much... if you practice at all, it's pretty much a guarantee, right? So your base effects and your comparisons were quite easy. Bringing that to inflation. Last year, you had a huge deceleration over the second half of the year in inflation. So this year, the comparisons or the base effects are easier, right? So... all right, with that, we'll go ahead and get into some of the questions here, and then we'll go ahead and wrap up. Let's first go to TikTok here. We'll switch up the order. We'll do TikTok first, and then after that, we'll get into Instagram as well as comments from YouTube, although I don't see any YouTube comments here. All right, let's see. Just scrolling through here 1 second. BR_research says they need to drop rates to 3.5. Why? You're assuming we can't grow at 4 to 5%. I'm not sure if you've seen what consumption has been doing, but it's been falling off a rock. So yeah, all of the GDP number acceleration that we just saw to 3%, That was a normalization in imports. BR_research. Yeah, so it sounds like BR_research really wants rate cuts and is definitely not taking a look at inflation reaccelerating and the base effects. Do you have hedges in place for tomorrow's CPI? Typically, when it comes to new events, I'm raising some cash. So yeah, I mean, over the past week or so, we were buying that dip that we saw a week and a half ago, and it's been last week was great. Had a good day today too. So yeah, just raising cash into that. Crypto alts are also bullish. DeFi projects, yeah. So decentralized finance, cryptocurrencies um, are looking like they're pretty bullish. Daryl, what's up, dude? Daryl super sad. High school buddy. Hope you're doing well, man. Okay. Any thoughts on overseas being potentially better return versus US? We could see inflows continue into emerging markets. I mean, emerging markets are doing really well. So, yeah, wouldn't be surprised. Are you expecting big sell if CPI is too high tomorrow? Potentially. I mean, what I'm thinking though is that, with inflation, with the 5-year break-even inflation rate decelerating in July, you might get a 1 month slowdown, which, that would actually be something that the market praises. And so you actually might get an acceleration higher, right? If you get a 1 month slowdown and, the market cheers. But again, that's only a 1 month slowdown. You have to look at what's happening for the remainder of the year. And because of base effects, you'll see, we have in our model seeing a reacceleration. Let's see. Do you expect a rate cut in September? I mean, I'm just going to go with what the market is pricing in. Um, I I know this is kind of not what the market is saying right now, but I would not be surprised if we get the September data having a hot inflation report, which they would be reporting August data in September. So it'd be the September report, but it would be August data. I wouldn't be surprised if that number has a pretty large acceleration, and then you get a potential flip flop. So I don't know. We may not see any rate cuts in September if inflation continues to be sticky. If you look at the 15% Nvidia now has to pay the government. Hey Johnny, what do you think about CAT and Microsoft? Both are in bullish trend, and yeah, I mean, both Microsoft will go over. Let's see here. No, Microsoft is not at the low of the range. Let's see. Did that BR_research? Did did he leave? Because I'd like to see if he had any other questions about inflation. But yeah, I mean, I would not be surprised just looking at volume as well. The way that volume has been performing, we had a pretty decent drop off in volume on this acceleration in prices. So I mean, it wouldn't be surprising if we saw volume reaccelerate as this corrected here. But we'll see. We'll see what happens. But yeah, that's pretty much all I have for you guys here today. Quick announcement, these daily live streams will be Monday through Thursday instead of Monday through Friday. So it's just going to be 4 days a week, right? I want to dedicate more time to research, as well as my wife has off on Fridays. So, I think we want to try and spend some more time on Friday afternoons together as well. So you got to prioritize, right? But yeah, so Monday through Thursday though, we're gonna keep kicking it off. Sundays at 8 p.m. still gonna be a thing as well. So you still have me for 5 days, Sunday through Thursday. But yeah, appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's daily macro update after the July CPI print. All right, everyone, have a great rest of your Monday here, and we'll catch you tomorrow.